Okay, so just a quick video on how to understand profitability, how to use it within a 25-mark essay, and lots of different factors to include. We don't want to just be basic and just go, oh, profit's gone up, profit's gone down. We've got a lot of factors we can consider. So I've broken it down into four components. We'll look at gross profit and profit for the year first. First thing we need to think about is that we've got to use ratios. We can't just go, like I said, gross profit goes up, goes down. We need proportional. So gross profit margin or markup, usually margin is the way to go. And if we're looking at gross profit margin, we're looking at the amount of gross profit we make for every pound of revenue. And so then we look at the factors that could cause gross profits to change. So we go purchase cost, the amount we actually pay for our purchases, has it gone up or down? Could it have an impact on our margin? We could link that further to quality as well. And so therefore that could be part of the question, that could be part of the discussion. We also look at carriage inwards. Carriage inwards often is forgotten when we're talking about gross profits. So carriage inwards is the cost of getting suppliers moved to us. So if there's something in the question about how close you are to suppliers or how that you're moving further away, then clearly that can have an impact on carriage inwards and therefore an impact on gross profit margins. Selling prices. So if we increase or decrease our selling price, that would clearly have an impact on gross profit. And so again, if you've got a product that is in a competitive marketplace, you might have had to reduce prices, which therefore would reduce your margins. Or if you've got a good quality or a niche product, you might have increased products. So customers are happy to pay extra. So that can improve your gross margins. Economy of scale, always a good point to bring in here. So are you buying in bulk? So if your company is growing or if it's decreasing, if you're closing a department, you might lose some of those economies of scale, which have an impact on gross margins or the profit mix of the products that you sell. So when I'm saying profit mix, you will have higher margin, you will have lower margin products. And obviously if you have a high proportion of one over the other, then that would have an impact on the gross margins that you would generate. So having to think of those and obviously then link those to recommendations if you need to, because adapting any of those could improve your gross profit. Profit for the year, so that's potentially more important, the overall profit that a company or business generates. So we want to compare the pattern for profit in relation to revenue to the pattern for gross profit margin. There was an essay from quite a few years ago where the gross profit margin was falling by around 8% and the profit in relation to revenue around 4%. So what that's saying is, yes, profitability is declining, but the impact's clearly gross margin related, not profit in relation to revenue related. And so then what you have to look at is what factors influence profit in relation to revenue, and it's expenses. So once you've gone through the gross profit element, it's expenses. So if profit in relation to revenue was falling at a lower percentage, that means we're saying we've got a better control over expenses. If it was different, we don't. And then we can drill down to individual expenses, and we can even look at expenses in relation to revenue. So we look at that proportion. So for that question, the expenses in relation to revenue was falling, just showing we have a tighter control over expenses, which means that when you were looking at options, you should have been looking at something that was more gross profit rather than profit for the year related, because that's what the data is telling you. But unless you do those calculations, you won't see that. So when we're looking at expenses, consider specific ones. So wages could be one, because clearly the highest expense for most companies is going to be the wage bill. Carriage outwards. So are we paying to deliver our goods to our customers? If we don't know, that's a limitation, but definitely a relevant point. Carriage outwards, remembering it's an expense. And then what do we do with that profit? So when we're analysing that profit's gone up or down, what are we doing with it? Are we retaining it? So are we keeping it to invest for the future? That's a good thing and a bad thing, because are you not actually, are you going to miss out on opportunities? Are you investing it? So you've invested that profit in a new expansion plan or a non-current asset, or are you paying it out in the form of dividends or drawings, depending on what type of business it is? So lots of different analysis that you can use there. Interest cost is also part of the equation. Are you borrowing money? What impact is an interest cost going to have on your profitability? Is it fixed? Is it variable? Lots of different arguments. We can then go deeper and say, what's the return on investment like? So obviously you can make a lot of profit, but if you invest a lot of money to do so, then actually maybe you're not making as efficient use of the capital as you could have done. So we look at the return on capital employed. So we look at profit relative even to the capital that's been employed in the company. We look at how efficiently the capital is used to generate a profit. And then we think about, obviously, the higher the better. So high return on capital employed, we're making an efficient use of our capital, so we're making a good profit. But then we've got to think short term versus long term. Are we just saying that it's low, it's a problem? Maybe we've made a big investment in something, so maybe that's something that will make a return. So item and machinery is going to take a while before it's going to generate the efficiencies and reduce costs to improve profit. Maybe we've expanded to a new location. That return's going to take a while before it generates a return. So what is your perspective? So who is it you're writing the essay about? Are you happy to wait for the longer term, or do you want the short term returns? And considering that is really important. And then again, we're still how are these profits distributed. So if we've got a high return on capital employed and you're a shareholder and you don't see that money, do you care? Probably, maybe, I don't know. But you need that return on investment to make it your benefit rather than just the business or company's benefit. So be careful what the question is asking for. Inventory turnover, which is at the top, just a slightly different angle there. Inventory turnover can be managed, interesting, calculated on rate or in days. So if it's on rate, how often do we top up our stock? If it's in days, how quickly we sell those items. But either way, we want to sell our items quickly, don't we? Because if we sell them quickly, we're generating more revenue, which should therefore lead to a higher profit depending on the returns on those products. However, that could link to prices, so it could link to gross margins. Maybe we're cutting our prices, and by cutting our prices, that's leading to an increase in sales, but not in gross margins. And then overall, that could have a negative impact on profit. But just on inventory turnover, we're happy because we're selling more. So how quickly items are sold is important, because if we're stuck with stock, so we can look at the impacts of unsold stock on profits. And if you've got that, you should be going down that line. So paying for storage, potential for shrinkage, i.e. theft. You got the items, could they become obsolete? Is it technology? Okay, technology, so they could go out of date. You lose money there. Is it perishable? You've got to throw it away. You could have disposal costs, or just literally the loss of the items. But then balance that. Are you running out of stock because you don't keep enough? So you could run out of stock, and then you've got an issue of lost sales and lost opportunities. So there's lots of analysis there. So just make sure that you think about profitability from the context of ratios, that you think about a wide range of points on what could increase profits, and not just focus on revenue increasing, expenses decreasing. Break down the individual elements, and what you'll find is your essay is more varied, and you can build in the context of the question in an easier fashion. Okay, good luck if that comes up.